Alright guys, welcome back to another video. So today we're going to go over my past investments in Robinhood and reveal whether I've made any profits or losses on them. And just to make it fun, we're going to compare my sell prices to today's price, and we'll see how much my stocks could have been worth if I've just held on to them. And let me tell you right now, I'm kicking myself on some of them. But then again, people say it's best to learn from other people's mistakes, so I hope you'll learn a lot from my video and my mistakes I've made while trading with Robinhood. But before that, as always, let's go over my retirement account with M1 Finance. And currently, as you can see, we're sitting at $18,749, which seems on par with what my previous balance was. I think it was $18,759, but between that time, I did deposit an additional $425, so in actuality, I'm down $434.74. But this is a retirement account, so instead of looking at the short-term fluctuations, I'm not really bothered by whether I lose $400 here and there. As long as my continuous long-term projection continues to go up, that's all I care about. So let's calculate my total return since opening my M1 account. And if you appreciate this level of transparency, don't forget to subscribe for more videos, because I want this channel to show that just about anyone can use the stock market to fund whatever future they have in mind. And since opening my M1 account, I currently have 4 different accounts with M1, and the total amount that I've deposited is $16,225. Currently, I am up $2,524.71, or for percentage, I'm up 15.59% since I opened my first M1 account and deposited back in September of 2018. And within the same time, as you can see, the S&P 500 has only gone up 8.42%. So even though I'm not beating the S&P 500 by a substantial margin, I'm still up substantially than if I would have just invested in a regular S&P 500 index fund. Of course, I'm not saying that my method of investing is better than any other investing kind, so I want you to figure out what kind of investing works for you in terms of risk and rewards. For myself personally, I find that owning individual stocks in good companies that I believe in, having them spread across in different sectors, works for me. As always, if you want to start investing, I highly recommend M1 Finance for their use of fractional shares and all those other benefits that I mentioned in my previous video. So if you want to open up your M1 account, check out the link down below. You'll get $10 free as long as you open and you fund your first account. So like I mentioned, I do have 4 separate accounts. This is the main one that I want to show you, and there haven't been any changes that I've made in terms of buying or selling different kinds of stocks. The only change I've made is if you go into my consumer pie. So I've been slowly selling off my Carnival share. It's not because I don't believe in the company in the long run. It's because, as you can see, I've had it set for just 10%, but because of the way that the stock has run up, it's currently at 15%. But it's only 50% because I've been selling it more and more. Before I started selling, it was up 21%. So because I didn't want Carnival to hold such a big weight on my pie, and because I wanted to lock in some profit, because the only reason the Carnival and other airline stocks have gone up is people are expecting the economy to rebound faster. But with the whole protests and states opening back up, and we are hearing news that there are increasing cases in a lot of the states, Carnival stock has been going down again. So by me selling right now, I'm able to lock in the profit so I can still benefit from this run up. And that's going to be the same method I'm going to use for my other holdings as well. That's it for my portfolio update. And let's get back to Robinhood and all the past stocks that I bought and sold. As you can see, I've bought a lot of stocks here and there, but I wanted to highlight 19 of the specific stocks that I've traded on Robinhood. I did have more than 19 stocks that I purchased, but I canceled them out because they were either stocks that I was thinking of buying and placed a limit buy, but I ended up canceling in the last minute, or it was stocks that I have basically broke even on, so it wasn't really worth talking about. The 19 stocks that I'm going to show you, I do have ones that have made substantial gains and I made profit on, but I also sold at a specific loss as well. Okay, so to make it easier for you guys to follow, I basically created this spreadsheet, and these are the 19 stocks that I'm going to be talking about today. And also these are all the stocks that I've sold out on before I moved over to M1 Finance. So the first column, of course, is going to show the name of the company. The second column is going to show the ticker symbol of each company if you want to look into them more. And the third column, the C column, basically is the total amount of shares that I bought and sold. and the D column is a total buy, so the total dollar amount of each individual stocks I have. And the very last column is going to show the average prices. And as you can see, there's lots of different companies that I personally wouldn't be invested in currently right now. When I first started trading on Robinhood, it was before I was more into researching companies, and I usually ended up buying and selling companies based on what I read on the news and all these things, which is the first thing that you should never do. That's the first mistake that a lot of new investors make, is that they judge and they make investing decisions based on what other people say, whether that be their friends or family or those stock analysts that they read on the news article or by watching CNBC or Bloomberg. Make sure you know what company you're investing in before you put in your hard-earned money in them. So we have basically Under Armour, which is an apparel brand, Chesapeake Energy, which have been in the news lately because they're about to go bankrupt. Third one is JetBlue, whose stock price is currently under pressure because of the whole coronavirus pandemic. Fitbit, this is the Vanguard Energy ETF. General Electric, Mattel, the toy company, GoPro, the action camera company, Snap, we have Starbucks, ConocoPhillips, Target, Skechers, Disney. This is Vanguard Information Technologies ETF. We have Alibaba, we have AMD, we have Netflix, and finally we have Apple. As you can see right here at the bottom, the total purchase and the total amount that I bought for is $7,395.55. Now let's find out what I sold it for. And we have two new columns. This is the total sell prices for each individual, and this is the average sell price for each individual stocks. As you can see right here at the very bottom, I calculated the total sum of up here. The total sell price, or the total amount that I've sold when I exited Robinhood, is $7,697.71. Now this is the big reveal that everyone I think has been waiting for. As you can see, thankfully, even though I purchased companies that I really didn't know anything about, I was able to take out a bit of a profit of only $302.16. As you can see, I've only had four companies that I ended up selling at a loss. The biggest winners for my Robinhood days was Apple, which I made a profit of $55, and also Netflix, which I made a profit of $55 as well. Well, so far everything has been in the past. In the past I made a profit of $302.16, but what do we want to find out right now is if I had held these stocks up until today, currently, June 16th of 2020, how much money would I have had? Or in other words, how much money did I miss out on by simply selling them out when I exited Robinhood? These are all the June 16th price of all these companies that I have. I looked them up on just Google and these are the closing prices for June 16th. And let's not waste any time, and here's a big review. There you have it. This is the breakdown of the losses that I would have made or the profit that I've made had I stayed invested in these companies. And as you can see from the very top are the companies that I would have made the biggest loss on. At the very bottom is the companies I would have made the biggest profit with. Under Armour would have been my biggest loss. As you can see, I would have lost $881 if I stayed invested. My sell price was $40, but currently as of June 16th, it is trading at less than $10. Of course, all of these stock prices are going to be a bit lower, and some of these reds would be in the green if it wasn't for the pandemic, but because of the pandemic, a lot of stocks are down. But I didn't want to pick the prices of when the stock market was at its peak. I just want to be realistic and just show you what it would be currently. So Under Armour was down substantially. Chesapeake Energy is a unique situation because even though I sold it at $6, and if you look at Google, the current price is $18.87. But in actuality, one share of Chesapeake Energy is going to be worth 0.094. The reason why, as you can see from their investor relationship pages, they announced a 1-for-200 reverse stock split, which means that because the stock price itself was already so low, they're going to do a reverse split. So they're going to gather 200 shares and combine them to just give you one share. So if you calculate 0.094 and you times that by 200, that'll give you today's price of 18.87. But because my sell price of $6.05 was pre-reverse split, I wanted to highlight this. That's one stock that I'm glad that I got out of. JetBlue is another victim of the pandemic because pre-pandemic, when it was at an all-time high in February, the stock was hovering around $21, which is higher than my average sell price, so this would have been in the green. But because of the pandemic, I would have made a loss of $512. Now, for those of you who remember, when Fitbit started trading, it went up substantially because there wasn't a lot of competitors in the wearable space. But ever since Apple came out with their Apple Watch, Fitbit has been slowly in decline, losing a lot of market share, and that's why Google is going to be buying them out soon. And this is another stock that I would have lost almost 50% on. I sold it at almost $13, but now it's only trading at $6, so I would have made a loss of $358. The energy ETF has of course been going down with the push towards new renewable energy. Same with General Electric, it went down substantially, and Mattel toy brand as well. Same with GoPro. So far we've only talked about all the losses, so I'm very happy that I missed out on all these losses, but this is the part where it's going to start to hurt. So let's start off with Snap. I would have made $12.55 profit if I stayed invested. Starbucks I would have made $20. ConocoPhillips I would have made $37. Target I would have made $44. Skechers I would have made $67. Disney, which I still owned of course, is going to be $71. VGT, which is the information technology for Vanguard, I would have made $81. Alibaba, another company that I currently own, I would have made an additional profit of $111 if I stayed invested. AMD, I would have made a profit of $165. But here's the thing, I only had 4 shares of AMD, and I sold them at $13. Today the price is at $54. So this amount would have been way higher if I had more shares. But these final 2 are the real kicker, and the ones I definitely regret the most. Netflix, almost $2,000 of profit I missed out on. And look at this, my sell price was less than $100, but right now currently a single share of Netflix is $425. But what hurts even more is my next pick. I missed out on almost $3,000 in just this one position alone. I sold it once again when the stock was below $100, but now it's at $343. So to summarize, throughout my Robinhood investing from 2016 to I think 2018, so about 2 years or so, I made an actual profit of only $302. But if I stayed invested in all of these companies, regardless of all the losses I would have made from these top companies too, I would still have made more than $3,000 in profit. This is profit that I missed out on because I chose not to think long term and because I sold out way quicker than I should have. But also because all these companies, at least some of them, I invested in not because I did my own research, but because I was looking at and I was anticipating and I was playing what other people was telling me. So that's the thing with investing. You're going to make a lot of mistakes. And I'm glad that I made these mistakes with Robinhood when I had less than $10,000 to invest with, because had I had more money, I would have made potentially more losses than I would have. But the number one thing that I want you to remember is that you need to know what you're investing into. When I invested in Under Armour, it wasn't because I read through the financials, but I saw that, oh, Stephen Curry and the Golden State Warrior, they are basically doing well. So just because of that reason I invested, which isn't a good investing advice at all. You need to do your research so you know what you're doing and find out whether the company is good or bad. Because if you're not, you're going to end up buying a Chesapeake Energy and you might end up losing all of your entire holding. And that's basically what a lot of people don't realize. This was a sad news article. As you can see, a 20-year-old Robinhood customer dies by suicide after seeing a negative balance of $730,000. But the thing is, if you read through the article, that negative $730,000, it was his temporary balance because what he was doing was basically a bull put spread. But it seemed like because he wasn't really aware of what he was doing, he saw that negative balance and he decided to take his life. And he left a message for his parents basically saying, how was a 20-year-old with no income able to get assigned almost $1 million worth of leverage? And like a lot of people who are jumping into investing right now because of the pandemic and who think, oh, I got a stimulus check, so let me just start investing as well. Please be careful and please know what you're doing. If you are new to investing, before you put any dollar amount into the stock market, make sure you do your research and you pick up an investment book and you read a few chapters so you can at least get an idea of what the stock market is all about. I got started in my investing journey by reading The Millionaire Teacher. I did do a review on that book on my channel as well, but that basically opened up my eyes to what the stock market was all about, the benefits of investing and diversification and the need to lower risk, but you're still able to get a lot of rewards thanks to compound interest. If you're new to investing, make sure to do your research and stick with just buying and selling stocks. Don't go into crazy things if you're not ready for them. Another mistake you can make is by thinking short term or think that you're going to be able to make money by day trading. Remember Chesapeake Energy? I would have lost the entirety of my holding. And the way I traded Chesapeake Energy is I bought them on May 3rd of 2016. And then I sold them on May 3rd of 2016. So I didn't even hold it for that long. And as you can see, I made a loss of $3. So thankfully, I was able to get in and out of Chesapeake Energy because I didn't know what the heck I was doing. But a lot of people now who just jump into investing treat it like gambling, treat it like casinos where they think, oh, if I just put it on red, I'm going to make a lot of money. But also forget, if it lands on black, then you're going to lose all of your money. So don't be trading in and out of stock, and don't treat stock market like a casino, because that's sadly what a lot of people are doing right now. You might have heard that Hertz, they are going bankrupt, but their share prices are still going up because a lot of people are buying into these bankrupt companies like Hertz, JC Penney's, thinking that they're going to get short-term profit by pushing up the share prices. Sure, some people might be making money here and there by doing these risky moves, but you have to remember that those are only few and far in between. The majority of those people who try to follow this day trading method, they're going to end up losing a lot of money. So it's best to just play safe. Investing is all about the long term. Wealth is created in the long term. Of course, it can be created in the short term, but that's kind of like just going to the casino or just buying a lottery ticket. It's exciting, but it's not going to be guaranteed, and you might just end up losing everything. The next investing mistake that you can make is by not diversifying enough. As you can see, even though I had all these companies that I lost substantial money on, because I had diversification and I owned Apple and Netflix and all these other companies that balanced it out, I was still able to get potential profit of $3,000 and I made the actual profit of $300. And of course, if you really wanted to, you don't have to diversify. Just look at this gentleman. He's a Chewy's founder and he put most of his money that he made from selling his company into just 2 stocks. What are those 2 stocks? He only invested in Apple and Wells Fargo stocks. Only 2 stocks, and he put in $3.4 billion into them. I don't know about you, but if I had $3.4 billion, I wouldn't be putting it into only 2 companies. Sure, Apple was great, but Wells Fargo, they've been lagging even their financial peers. Chances are, if he was more diversified and he had a bit of McDonald's or Coca-Cola, we can assume that his return might be better. Of course, the more you diversify, your overall return is going to be lower, but at the same time, you're going to have less risk. So if you're new to investing, think about diversifying. Don't go all in on Hertz, because once again, if you invest in Hertz, you could end up being bankrupt right now. The next investing mistake that people make is investing money that you can't afford to lose. So I'm going to tell you a story. Before I invested in Robinhood, I used to invest with Scottrade, and this was during my college years. One summer, I was investing with Scottrade, and my parents, they sent me a tuition money, almost $9,000. What did I do with that? Did I put it away in a savings account or checking account? No, I put it in the stock market. I don't know why, but I decided to play JetBlue earning. So basically what I saw was every time JetBlue releases an earning, the next day the stock would dip. But then on the same day, the stock would go climb up steadily, and then it will end up always 8% or 10% higher. And this was through no research on my own. It was just me just looking at the pattern. Oh, the past 2 quarters, it always opened low, but always ended up selling high. So that's basically what I did. JetBlue, they released their earning, and I didn't really see what their earning was about. I didn't really care. The next day, I basically bought when the stock was negative, and then thankfully, the stock did go up to the green, and I basically sold out. I think I made a profit of about $400 or something like that. And just think about it, $9,000 I could have basically blown away. It could have basically dropped 50%, and I would have been down $4,500. I would have been kicked out of school because I wasn't able to pay for my tuition. So remember, invest with money that you can afford to lose. Or if you're going to be investing in your retirement or anything like that, don't invest with money that you're going to need in the short term. So if you need the money between 1 to 3 years, chances are it's better to just take that money and put it in the high yield savings account like Marcus by Goldman Sachs. But even with those online savings accounts, I think last time I mentioned they had a return of 1.3, but now they're down 1.05. So it might be tempting to just think, oh, why would I put money in a high yield savings account earning only 1% when I can potentially put in the stock market and earn about 8% or 10%? Sure, that is possible, but you might be hit with a pandemic and the stock market might crash 40%. Do you really want to risk that money if that money is used for your tuition or your child care or a mortgage on your house, anything like that? Personally, I wouldn't risk it. Keep invested for the long term, and I don't do short-term plays or anything like that, and I definitely don't play with earnings. And speaking of investing in the long term, you might be thinking right now, oh, the stock market went down and I missed it on the way down, but the stock market is coming back up. I think I'll wait until the stock market goes down to start investing. But here's the thing. What if the stock market never ends up going down? What if because of this Fed stimulus and all this positivity and optimism, what if the stock market goes up higher and higher? you're basically locking in your losses. By not being invested in the market, you're missing out on all the gains that you can possibly have. And you look back in history, every year there's a reason why you shouldn't be investing. When I opened up my Robinhood account in 2016, Brexit was happening. 2017, it was the North Korea missile crisis. 2018, it's the Chinese-United States trade war. 2019 is Donald Trump's impeachment. And in 2020, we have the pandemic. So as you can see, if you look for reasons to why you shouldn't invest, there's plenty of reasons. Even right now, we're in the midst of a pandemic. Stock market is going up, but there's always a possibility of the second wave or the third wave, the vaccine not working properly, which will make the stock market go down. Or on the flip side, the vaccine might be discovered and the stock market might go up. It's best not to time the market. If you're going to be investing in the long term, and you put $5,000 into the market, and you're going to put $200 every week, does it really matter if you buy Apple stocks, for example, at $350 or $450 if you think that Apple's going to go up higher? I personally don't think so. That's why I dollar cost average in. Regardless of when the market is up or down, every week I have a set dollar amount that I choose to invest. And you should too, because dollar cost averaging into great companies is going to take all the guesswork out. You're not going to be swayed by emotions. You're not going to try to time the market. By dollar cost averaging, you're going to end up way better than if you are just contemplating on each individual event's macro or micro economic movements. And to end the video, I leave you with one of the most famous quote that I'm sure you might have heard of. It's by Warren Buffett. He has 2 rules of investing. The first rule is to never lose money. And the second rule is never forget rule number 1. Investing is a long-term game. If you try to play short-term, you might end up winning here and there, but in the long run, you might end up losing. I hope you learn from my mistakes, but at the same time, don't be afraid to go ahead and make your mistakes, because that's the best way for you to learn. But just to minimize your risk, if you're new to investing or if you're unsure of investing, of course, start off small and invest in good quality companies for the long term. And the easiest way, at least for me, to invest is by using M1 Finance. If you want to know of all the reasons why I like M1 Finance, check my video that I made previously. But if you want to open up your account and you get started right away with M1 Finance, use the link down below in my description to receive, once again, $10 when you open and fund your M1 Finance account. That's it for today. Thanks as always for stopping by. If you lasted this long, press the like button once. And if you don't want to, press the dislike button twice. But in any case, I'll see you all next time with more financial shenanigans.